Good morning all. Today's topic is on buyback of shares. Buyback of shares is nothing but a mechanism the company adopt to repurchase the shares which it had issued earlier from the existing shareholders. Salient features of buyback, it really boosts up the share prices. Once the company announces the buyback, the share prices will automatically shoot up. It's an alternative and tax efficient way for the company to return money to its shareholders. A company can issue the money back either in way of dividend or in the way of buyback and other ways too. But it's a tax efficient way because the dividend is a tax appropriation of profit, and it's deductible under tax at source at 194, and it's also taxable under the shareholders at their tax level. So buyback of shares is taxable under the company only, and it's completely exempt under in hands of shareholders. Once a company purchases its own shares, the shares must be cancelled by the company. It cannot redistribute the shares to anyone once again. It helps in improving key ratios and theoretically improves valuation of the company. The buyback of shares generally improves valuation of the company, but in reality, the company will buy back the shares once it came to know that the growth aspects and the key opportunities becomes less. So buyback can be made from the free reserves of the company, security premium account, and process of any other securities. It cannot buy back from the issues it made through the issue of equity shares once again. Eligibility norms for issue of for share buyback: 1 year over from completion of previous buyback. There should be a period of 1 year between the previous buyback and the buyback conducted during the current year. Shares or other specified securities to be bought back must be fully paid up. The shares must be fully paid up shares, and the sources of funds should be like what I said before. The company cannot use the proceeds of proceeds from the earlier issue of the same kind of shares. It can issue preference shares. Through that, they can buy back the equity shares, but it can't issue equity shares to buy back the equity shares. So that makes no sense to buy back the shares itself. Securities eligible for buyback: equity shares, preference shares, and employee stock options, and other securities as may be specified by the central government. So the company cannot borrow from any bank just to buy back the shares. So why the company undergoes buyback? To increase the market demand by reducing the number of shares. So the number of shares available in the market will get reduced, which increases the EPS. Thereby, the company's price will automatically shoot up. To distribute the excess cash available with the company to its shareholders, to reward the shareholders at substantially a price higher than the market price. So generally, the buyback price shall be their price more than the market price prevailing during the period. If dividends are provided to shareholders, they get taxed in the hands of shareholders. So earlier I said the dividends are taxable at the company level by TDS, and it get taxed in the hands of shareholders also. Under buyback, it is taxable under the hands of a company, and it's exempt in the hands of shareholders. So a company doing buyback must comply with the Companies Act and SEBI if it's listed entity. If it is not a listed entity, it has to comply with the rules and of the company's rules. A company can buy back shares through those two means. One by the shareholders resolution passed in general meeting, and other by the directors resolution passed in the board of directors. If the buyback of shares is 10% of the equity share capital, it can go through the board resolution. By passing the board resolution, it can buy back. So if the buyback amount exceeds 25% or it's more than 10% means it has to buy back the shares after passing the shareholders resolution. So regulations governing buyback. Buyback must be authorized by its articles. Special resolution needs to be passed at company general meeting authorizing buyback. However, buyback can be made with the approval of directors, which means if the buyback of shares is 10% or less than 25% means it can buy back the shares by passing a board resolution itself. As I told earlier, only one buyback shall be allowed in a year. There should be a year gap between one buyback and the other. Buyback through the shareholders resolution also cannot exceed 25% of the total paid up share capital and free reserves. After the buyback has been made, the aggregate of debt to equity ratio should not be 2:1. Greater than 2:1. All the shares must be fully paid up. The buyback of shares listed on each stock exchange shall be comply with the SEBI. After the unlisted shares has to comply with the Rule 17 of Share Capital and Debentures Rules. So once the buyback has been started and board resolution has been passed, within a period of 1 year, the buyback has to be completed. These are the particulars with which an explanatory statement has to be issued to pass special resolution. The buyback may be made from the existing shareholders, from the open market, and by purchasing the equities issued to the employees under ESOP scheme. No buyback shall be made out of the proceeds of an earlier issue of the same kind of shares. So before the buyback starts, the company has to file a declaration of solvency with the registrar, stating that the company won't get dissolved or liquidate after the buyback. So it has to be signed by at least 2 directors, and it has to be verified by an affidavit. In case of listed entities, the solvency declaration has to be filed with SEBI also. After a buyback has been made, a company shall destroy physically the shares or securities being bought back. After a buyback has been announced, the company cannot issue further shares and allotment of new shares. It can issue only bonus shares or conversion of warrants, stock option schemes, sweat equity, or conversion of preferentials. Apart from this, the company should not do any other kind of activities regarding securities. A register containing the particulars of buyback shall be maintained with the company. Within 30 days of the completion of buyback, return shall be filed with the registrar in case of non-listed entities, with the SEBI in case of listed entities. So, if the company is buybacking the shares from the securities premium account or free reserves, it has to transfer a sum of nominal value of the shares being bought back, and it should be transferred to the securities capital redemption reserve account, and details of such transfer shall be disclosed in the balance sheet. This amount can be used to issue bonus shares. So, buyback cannot be made in these circumstances. The company cannot make any buyback through any subsidiary company, through any investment company, and if any default has been made by the company regarding the deposits or payment of dividend, and the default is remedied before 3 years, it cannot make buyback of shares. So the companies which are not in compliance with Section 92, Section 123, Section 127 and Section 129 of Companies Act can't do buyback. The penalty for non-compliance for company from 1 lakh up to 3 lakh will be the penalty amount, and for every defaulting officer, imprisonment up to 3 years and fine, monetary fine of 1 lakh up to 3 lakhs, or both shall be levied. For listed entities, SEBI has been issued a guidelines to make buyback. So the listed entities can make buyback through these options: tender offer, and open market route, and odd lot holders buyback. The tender offer means a method through which a company can buy back at a fixed price. The company cannot buy the shares back more than the fixed price. Open market route means the company will buy back the shares from the open market itself. The company will fix the maximum limit to the company may fix the maximum limit, and the company will buy back the shares at any price within that limit. So the resolution passed at the general meeting within 7 days of the passing of resolution shall be filed with the SEBI and the stock exchanges. If the company is buying back their shares through the board resolution, the resolution of board shall be filed with the SEBI and stock exchanges within 2 working days of the date of passing resolution. The consideration for buyback should be paid only in cash. The company cannot issue any specified securities till the date of closure of the offer. The company cannot withdraw the offer to buyback once the letter of offer has been filed. Promoters cannot deal in specified securities in the stock exchange during the period when the buyback is open. The company cannot buy back locked in and non-transferable securities until they become free. So under Rule 17 for listed unlisted entities, an explanatory statement has to be sent along with the notice for general meeting, stating the particulars of objective of the buyback, date of the meeting, class of shares that being bought back, number of securities that the company proposes to buy back, method to be adopted, the price, and the basis of arriving at the buyback price, maximum amount to be paid, and the time limit. If the aggregate shareholding of the promoters so the quantum of shares to be tendered will also be included in the explanatory statement itself, and details of their transactions of the promoters and their holdings during the last 12 months prior to the date of board meeting should be included in that explanatory statement. So the company has not defaulted in any repayment of deposits, interest payment, or redemption of debentures, redemption of preference shares, or payment of dividend due to any shareholders. A confirmation that the board of directors have made a full inquiry into the affairs and prospects of the company. The company has not found it unable to repay its debt. The company shall be able to meet its liability, and the directors have taken into account the liabilities as if the company was being wound up. So it's basically the company has to ensure that the company won't wound up after the buyback has been made. So along with that, the company's a report has to be given by the company's auditor stating that it had inquired into the company's state of affairs, amount of capital payment for securities is properly determined, audited accounts on the basis of which with reference to buyback is done. And the financial statements should not be should not be older than 6 months from the date of a document. The board of directors have formed the opinion and that the company shall not be rendered insolvent within the period 1 year from that date. The company which has passed special resolution shall file a letter of offer in form SH8 signed by at least 2 directors with ROC before the buyback of shares. In case of listed entities, the company shall file with the registrar and SEBI a declaration of solvency in form SH9. The letter of offer shall be dispatched to the shareholders within 20 days from its filing with the registrar. The offer for buyback shall remain open for a period of 15 to 30 days from the date of dispatch of the letter of offer. If all the members agree, offer may be open for a period less than 15 days. In case the number of shares offered by the shareholders is more than the total number of shares to be bought back, the acceptance shall be on a proportionate basis. The company shall complete the verification of the offers received within 15 days from the date of closure of the offer. Unless rejection has been communicated within 21 days, offers are deemed to be accepted. The company shall immediately after the date of closure of the offer open a separate bank account and deposit there the sum to be paid as consideration for the shares. The company shall within 7 days make payment of consideration in cash to the shareholders, return the share certificates if they are not accepting the shares. The company shall ensure that the offer letter shall contain true, factual and material information and shall not contain any misleading information, and must state that the directors of the company accept the responsibility for the information contained in the document. The company shall not issue any new shares, including by way of bonus shares from the date of passing of special resolution. The company shall confirm in its offer for the opening of a separate bank account funded for this purpose and to pay the consideration only by way of cash. The company shall not withdraw the offer once it has announced the offer to the shareholders. The company shall not utilize any amount borrowed from banks. So the company cannot borrow amount from the banks just to buy back the shares. The company shall not utilize the process of an earlier issue of the same kind of shares or other specified securities for the buyback. The company shall maintain a register of shares which have been bought back in Form SH10. So the register will be maintained under Form SH10. The register of shares shall be maintained at the registered office of the company and shall be kept in the custody of the secretary of the company. The entries in the register shall be authenticated by the secretary of the company. The company shall file a return in Form SH11 with the registrar after the buyback. There shall be annexed to the return filed with the registrar in Form SH11 a certificate in Form SH15 signed by 2 directors of the company, including the managing director. So before buyback was charged as capital gains in the hands of shareholders and dividend distribution tax was paid by the company before 2020 budget, and an amendment was introduced as an anti-tax avoidance measurement in the evening budget of 2019, effective for all buybacks post July 2019 and be applicable for both listed and unlisted entities. Section 115 QE of the Income Tax Act prescribes that the the tax shall be levied at the rate of 20% plus surcharge 12% and cess 4% shall be levied on the distributed income within 14 days from the date of payment of consideration to the shareholders. Distributed income is nothing but the consideration paid by the company deducted by amount received by the company for issue of such shares. Even if no income tax is payable by a domestic company, the tax on distributed income under Section 115 QA shall be payable by such company. In the hands of shareholders, it shall be exempted for both listed and unlisted entities. So in case the company buys back securities from the foreign shareholders, then FEMA regulations would apply. RBI has now put the buyback of shares from foreign investors on an automatic route. Earlier, it required prior permission from the RBI. The company must be eligible for automatic route investment under FDI policy. That is, it must not be in a restricted sector. The pricing guidelines specified by the SEBI, by the RBI are adhered to. Form FCTRS along with the relevant annexures is filed with the authorized dealer. Form FCTRS will be filed for any transfer of equity instruments in accordance with the rules between a person resident outside India holding equity instruments in an Indian company on a repatriable basis and a person resident in India. Automatic route is not available for companies operating in the financial services sector. Example, banks, insurance companies and NBFCs. So it's just the snippets of the procedure. The articles has to authorize, the board meeting has to be convened, and in case of buyback is less than 10% of paid up share capital. If it is more than 10% of paid up share capital in free reserves, general meeting of shareholders has to be convened to pass special resolution. Form MGT 14 shall be filed with the ROC within 30 days of passing resolution. In case of listed entities, declaration of solvency along with Form SH8 and the letter of offer has to be filed. In case of unlisted entities, Form SH8 has to be filed. Letter of offer has to be dispatched to the shareholders. Offer period at least 15 days or within 15 to 30 days, the offer period shall become ended. Verification of offers received within 15 days from the date of closure of offer. Transferring certain sums to the capital reduction reserve account. Opening a separate bank account after the date of closure of offer and deposit such sum as would make the entire sum payable. Make payment of consideration in cash to shareholders and returning back the securities which the company hasn't accepted. Extinguishment of securities within 7 days from the date of completion of buyback. Form SH11 along with Form SH15 has to be filed within 30 days of the completion of buyback. Maintaining the register of buyback and the securities in Form SH10 at the registered office of the company in custody of the company secretary. The consideration to be paid by the company shall be taxed at 20% as per 15 QA and no such tax liability falls on the shareholders. Form FCTRS has to be filed by an Indian company buying back its shares if shares are being bought back from the non-residents. The time as may be prescribed. Any questions?
Yes. So what is the purpose of buyback? So why does a company need to buy back its shares?
That once a company attains a mature stage, the company will hold large chunk of cash. In that case, the company will issue either dividend or it can buy back its shares. So that the the excess cash lying with the company will be distributed to the shareholders. If the company doesn't have any investment opportunities or any investment options left, the company can issue buyback just to
So,
return the money back to the shareholders.
okay, so what is the impact before buyback and after buyback?
The share prices will shoot up in case of listed shares, and the the company valuations might go up.
Is there any other impact other than on the share price part or on the valuation part?
Yeah, it will improve the share price, but ultimately the share price will raise up and the valuations look nice.
And I also think the shareholding patterns might have changed.
Yeah, the promoters will get back their shares back if the promoters are in fear that the shares are getting diluted among the shareholders.
Yes. Okay.
Any other questions?
So, what is the benefit or what is the analysis between buying back its own share or buying the shares of another company? You are saying that the company is having excess cash, so it could have invested in acquiring some other company now. So, why they should buy back the
If
whole
the
company share?
if the growth opportunities are less, if the company see the Reliance Industries have been investing in along among among other industries around around India. So it's up to what to say. It's up to minerals industry. It's up to what consumer FMCG sector. It's up to um, telecommunication sector. So not all companies have such growth aspects. So if the company thought that it has no growth aspects, it left with no investment opportunities, then only the company can can announce buyback. So mostly the telecom companies like TCS, Infosys are among those other companies will announce buyback.
Who will determine how much need to be buyback? That is how much need to be bought back, or is there any rule this much can
Yeah,
be
the
bought?
company cannot buy back more than 25% of its paid up share capital and its equity of free reserves. More than that, it can't buy back.
No, I think it is 10 percentage. 25%
10
is the
percentage for board resolution.
board resolution. Okay. So in AGM, we can approve up to 25 percentage of buyback.
Yeah.
Okay.
I have a doubt regarding the SEBI guidelines.
Hmm.
You said some methods. Can you explain it again? That book building process, tender price.
Yeah, tender offer means the company will fix a price. The company, even if the shares are being traded at a low price than the fixed price, the company will bought back the shares from the shareholders at the fixed price itself. Uh, that Under the open market route, the company will buy back the shares from the shareholders at the rate even below the fixed price. It's not that the company will buy back at the fixed price. It can be lower than that also. So that's the major difference between those two offers.
And the third one?
Same as the tender offer only. The company will buy back the shares on the proportionate basis from the shareholders at the fixed price itself. Any other questions?
I have a doubt in practical aspect. So you're saying buyback, right? The company will get the help of SEBI and get back the shares, or the company directly goes to the shareholders and asks the shares.
The company will
So-
offer a buyback.
Okay.
It has to comply with the SEBI regulations. In case of listed entities, it has to comply with the SEBI guidelines.
So if no one is willing to give their shares, then what would happen?
The company can't compulsorily
Acquire the shares.
It's an option to the shareholders to give their shares back.
So only if it is beneficial to the shareholders,
Yes.
they can buy
Yes.
back. Otherwise, they're
The,
not in a
co- by,
compulsion.
the company has no compulsory, cannot compulsory acquire the shares back from the shareholders.
Okay.